Today's topic is a timely one. It is certainly grabbing some headlines. And the question that we are going to try to answer today for you is, should you add private equity to your 401k?
So for those investors who are close to retiring, this may not make sense if you don't have a time horizon that's greater than 10 years. So definitely something to consider.
So what you don't want is for people to put all their money into crypto or into a private asset. Something goes wrong and then, they're 65, ready to retire and have no money in their 401k.
The cynic in me obviously feels like it's a money grab.
Hello, welcome back.
Hello, so good to see you, partner.
Great to see you too, partner, as always. And welcome back to all of you viewers, listeners. Welcome back to Living Richly with Curo. This is episode 67. We are so grateful to have you here each and every week, whether you're an OG listener from the very beginning or this is your first time listening. We appreciate all of you and very warm welcome.
Yeah, so nice to have you either joining for the first time or coming back. We love when you guys check us out.
Yes, we do. So if this is your first time, we are here to educate, to inspire, to empower you on your financial journeys. And today's topic is a timely one. It is certainly grabbing some headlines. And the question that we are going to try to answer today for you is, should you add private equity to your 401k?
Mm.
It's a big topic.
It's a huge topic. Yeah, for sure.
It is. It is. So in case you are not aware, in case you just tuned out the news, which props
Fair.
to you if you do that, props.
Understood.
We are not judging. Yeah, we are not judging you if you are not aware of this. But on August 7th, President Trump signed an executive order, which will make it easier for everyday Americans to access private investments. So think private equity, possibly private credit, crypto, private real estate. So investments that have not traditionally been accessible in retirement plans like 401k. This executive order makes those more accessible to add to your 401k. And what's interesting here is, according to Bloomberg, about a week before Inauguration Day in January, roughly 30 money managers hopped on a Zoom call and were strategizing all around how do we get more investors into our funds, because apparently word on the street is the institutional money managers, pensions, and things like that have kind of already been tapped out. And so this strategy session, if you will, according to Bloomberg again, was an attempt to talk about how do we get into new markets. And allegedly, the idea of the 401k market came about probably before this Zoom, but certainly on this Zoom, because it's a $12 trillion roughly market. So we are talking beaucoup dollars. And this was, very much planned and very much strategized as a way to try to expand their market. They have not really historically been able to tap the retirement plan market and sort of individual everyday Americans. And so here we go. On August 7th, President Trump signed that executive order. So we are going to break this down for you. We're going to talk a little bit more about what are private investments, how do they work? And then, as we always do, we're going to approach this decision and we're going to tell you what are some possible pros, some possible upsides to this potential investment opportunity. And then, of course, what are the things you should consider from a risk or downside perspective? So that's how we really always approach giving you all our insights here on the podcast, and also how we approach working with clients each and every day.
Yeah, we want you to have all the facts so that you make educated, informed decisions. Alrighty, so we will start by a quick background on what exactly is private investment or private equity. So we want you to think of these as investments that are not publicly traded. So when you think about the investments either currently in your 401k or in brokerage accounts, these are positions like stocks, exchange traded funds, bonds, things that have some market where they trade daily and have that liquidity. Private investments do not. And they have historically been limited to, as Ann already mentioned, institutional investors. So think big money managers, but also pension funds, very high net worth individuals, or what we call accredited investors, who have certain amount of investable assets, certain amount of net worth. And the reason is because typically to get into these types of investments, there are higher minimum investment amounts. There are also typically higher fees. There's more risk associated. And then one of the biggest ones is a lack of liquidity. So they're usually reserved for higher net worth or bigger investors who don't need the daily or instant liquidity associated with publicly traded companies. So this means that if you were to own these type of investments in your 401k plan, you couldn't just readily sell them every day. Let's say you needed to take a distribution for some cash need. They don't have any readily available liquidity to them. And this is why they haven't historically been introduced into 401k plans. These kinds of retirement plans are governed by a legislation known as ERISA, which has all sorts of implications around fiduciary responsibility in plans and what can be owned and how they should be managed. Because the idea is to protect the average retail retirement saver who's looking to grow a nest egg. So there are concerns around the complexity of these type of investments, the fees associated with them, restrictions. Of course, we mentioned the liquidity, and we've seen in the past lawsuits arise for different employers' retirement plans when the investors felt as if the investments weren't managed according to their investment needs. So it's something to consider when you start talking about private equity or private investment. Investors don't typically have access to them unless they have the net worth and the assets to sort of stomach that loss of liquidity, the higher fees, and the risk.
Right, exactly. And just to double click a second on kind of what is private equity and how does it work to the illiquidity factor. When you think about how private equity works, oftentimes these private equity companies will come in and take over another company, and not always, but a lot of times it's a turnaround sort of situation.
Mm-hmm.
And so private equity companies will, take a look at, okay, what strategies do we need to implement, or what sort of hiring or what sort of reduction in force do we need to do to turn these companies around? And that takes time, right? You're not going to turn a company around overnight. And so typically what we'll see from a time horizon perspective with these investments is somewhere between 7 to 10 years. So if you think about that, and we'll talk a little bit more later about what you should consider in your own individual situation, but unless you are in the earlier stages of your career where you have decades before you need to use these retirement funds, that is something absolutely to be aware of, is that when we say illiquidity, we mean illiquidity. That's how these products work, is they need the time to invest the capital so that they can turn these companies around and oftentimes then sell them, generate a profit, and you get your money back. So we're going to start with possible upsides and some potential positives, because as we said, we're going to approach this from a pros and cons sort of perspective. So one of the possible upsides is this does potentially give you access to more diversification. So we talk a lot in our firm every day with our clients, as well as on the podcast, about the importance of diversification. So we don't want all of our eggs in one basket. We don't want to own, one stock, for example. We don't even want to just own something like the S&P 500, right? We need diversification in our portfolio. So this could potentially give you access to another asset class or multiple asset classes that you otherwise have not had access to when you think about traditional stocks and bonds. So that could potentially be an upside. Secondly, there is the possibility for higher rates of return. So in some cases, some of these private investments do outpace or do beat certain indexes that we use to benchmark rates of return and portfolios. And then lastly, this could give folks access to institutional level investments. So as Atricia mentioned, usually these are reserved for either very high net worth individuals or institutional investors. So big pension funds like CalPERS and Yale Endowment have used private investments, and many others, by the way. These are just two that we're naming, but they have used private investments historically, and they have attributed part of their good performance to the fact that they have private investments. So that those are some of the potential upsides that we have identified for you to take into consideration when you're making this decision for yourself.
Yeah, for sure. And even with some of our clients here at Curo, we talk to them about adding private investment to their portfolio for that diversification piece. So we think about a year like 2022, when stocks and bonds were down, right? Further diversification into private markets will often add some performance that doesn't directly relate to what both stocks and bonds are doing at any one time, which, in many portfolios helps to improve the long-term performance. But of course, there are risks and concerns that come along with that potential higher upside, which we will talk a little bit about, just a few of them. I will preface this with, you still want to consult with a professional before making these decisions, but here are some things to consider. So we talked a little bit about the fees. These products tend to have higher management fees. It's typically a management fee, so maybe like an upfront expense that you would pay at investment, plus some portion or percentage of the profits. So you think about investing 100,000, there may be a 2% upfront fee, and then any growth or earnings above that, the manager may be entitled to a percentage of that growth. So this is typically higher than most even mutual funds and bonds that we use, but especially when compared to those typically used in a retirement plan, which have certain restrictions around the fees that can be assessed on the funds you own in those plans, by nature making them more cost effective. There's also the concern around the liquidity. By definition, they are not liquid assets, as Ann already mentioned. Typically, your money is tied up in these investments for a minimum of 7 to 10 years. Ann and I have both seen them go longer than that in many cases, because often it's left to the manager's discretion. So for those investors who are close to retiring, this may not make sense if you don't have a time horizon that's greater than 10 years. So definitely something to consider. And then transparency and valuation also become an issue with these types of investments. So unlike publicly traded stocks and other asset classes, most private equity funds report their valuations on a quarterly basis, and they can be a bit more subjective because, as Ann mentioned, if you think about the example where a private equity fund has purchased a company, many times the valuation of what they think that company is some combination of reporting, right? It could be how many times earning, because again, these are not publicly traded companies, right? So we're not looking at stock price. So it's something to remember. By nature, you're used to logging into your 401k administrator's platform, seeing how the value has changed from day to day if you're a daily watcher. In this case, you wouldn't see those valuations fluctuate so frequently just because of the limited valuation period and transparency around how valuation is actually done with a lot of these funds. So something to note. And then there are also regulatory concerns. So plan sponsors still have a fiduciary responsibility, right? We talk about that word a lot. And really what that means is putting the investors' needs and goals ahead of your own as the investment manager. And so there's this uncertainty around, even with this now being allowed, how many fund managers and plan administrators will really allow the investments to be used in the plan.
Yeah, exactly. They're still fiduciaries, and they're
Right.
still going to be concerned, as you said earlier, about possible lawsuits because they have happened
They
before
have
in the
happened.
past.
Yep.
Okay, so what does this all mean to you? First of all, take a pause, take a breath. This is not a decision you have to make today or tomorrow. So just because the executive order was signed does not mean that all of a sudden you will start to see private investments on your dashboard when you log onto your 401k immediately, right? Anytime large changes like this happen, there's obviously a lot that these plan sponsors have to work through, and they need time to update what their policies and procedures are going to be and how they are going to possibly incorporate investments like this into their platform. And then, second thing for you to remember is we're not exactly sure what this will look like in the future, but it is likely that investments like this may be offered as a portion of some sort of target retirement date fund. So, you're probably aware of the target retirement date funds that you already have access to in your 401k. So, maybe the way this looks is as a sleeve of that target retirement date, possibly, 5, 10, 15%, something like that could be in the alternative sleeve. But as you get closer to that target retirement date fund, it's likely that maybe some of those alternatives or private investments will roll off because of the liquidity issues. So that's kind of how we're thinking this may actually be implemented. So here are some key questions to ask yourself if you do have this offered to you and you're trying to make the decision. As Atricia mentioned earlier, we're huge believers in always consulting your advisors, whether that's us or another advisor or CPA. But the first question to ask is, what is an appropriate allocation percentage? So just like we talked about diversification, this is not something that you want to go all in on, right? We want you to have that diversification. So depending upon your age, maybe it's somewhere between 10 to 20% max in this sort of investment. How liquid is the potential investment that we're talking about? So, really understanding that liquidity that we've mentioned multiple times during this conversation, and also assessing your particular liquidity needs. So, if you are in your 20s or 30s and you can't touch your 401k or other retirement plan until 59 and a half anyway, you have the stomach for some illiquidity, right? If, on the other hand, you are 55 and you are close to retiring, then we would probably encourage you, depending upon your situation, to just be a little bit more careful about that liquidity in case you need access to these assets. As Atricia mentioned earlier, understanding the fee schedule is very important. I'm curious to see if there is any reduction in fees in these products as they get added to 401k plans, because in general, there has been a focus on trying to minimize fees inside of 401ks. So it'll be interesting if they're still allowed to kind of get away with the higher fee structure inside of 401ks. So TBD on that. And then lastly, you want to look at the manager's track record. How has the manager performed in different market environments? As Atricia mentioned earlier, 2022 is a great year to look at because that was a year in which both stocks and bonds actually performed very poorly. They were both negative. So seeing how alternative investments or private investments act when other areas of the market are doing well or doing poorly is very good information. Not that it will happen the same way every time, of course, but it's good information for you to have. So lastly, we just wanted to spitball a little bit on what each of our overall thoughts are on this topic at this point. So Atricia, you start. What's your general view on this topic so far?
Oh, I have so many. But I think to boil it down for purposes of this podcast, the cynic in me obviously feels like it's a money grab, right, for big money managers, and less about serving or giving access to, more investment opportunities for the average Joe. That's what the cynic in me says. Because this executive order not just makes way for, what we think of as traditional private equity managers, but also for investment in privately held companies like, the company that owns ChatGPT, OpenAI, and Elon Musk's SpaceX, right? So I think there's some strategize, some Dr. Evil strategy behind the scenes that's been the impetus for this. The other side of me does think that it might present some opportunity to younger retirement investors, right, to potentially boost returns over the long term through further diversification. I do like the idea of that. I think the part that worries me the most, though, and we've seen this even with clients that we start working with, many average Joe investors don't monitor investments in their 401k plans regularly. I mean, how many times have we looked at a 401k statement and it's like, I can't remember the last time I looked at this. I don't know what investments I own. And I think the complexity around private investment requires more attention, right? It requires a deeper level of understanding. It's not just like picking a target date and letting the active glide path do the work for you. So I think that's the part that worries me, is that most people will want to invest in these things when they don't necessarily understand the implications of them fully. Now, I would like to
Yeah.
think that every 401k investor is working with Curo Private Wealth and getting really good, sound, comprehensive guidance and planning advice. But that's not the case. And we know that for a
Right.
majority of investors. And I think just in general, that's what troubles me about it, even though I see how it could present a great opportunity.
Yeah. I completely agree with you. It's not even really a cynical take. I think if you look at the data leading up
Yeah.
to this executive order and this decision, it is very much okay, how do we get into new markets? I don't get the sense that this is from a place of let's help the everyday investor get access to something that they've never gotten access to before. There are reasons that the everyday investor has not gotten access to these
Hmm.
sorts of investment vehicles in the past. And it is because of the extra level of complexity and the illiquidity. And that's why the regulatory bodies have said, okay, in order for you to even qualify to get into these investments, these are certain minimum, net worth or income or whatnot levels that you have to hit. I think that is very much by design and for a reason. So, as Atricia already mentioned, we are definitely believers in having exposure outside of traditional stock and bond market. So we do alternative investments in our firm when it makes sense for clients. We're definitely not saying that it doesn't make sense, but I totally agree with your point that this is not coming out of a place of generosity or, really wanting to take care of the average American.
Right.
One. With that being said, I think that it could make sense for people to possibly take advantage. And like you, I think there has to be some protocols in place before people can invest. So either it's got to be as part of a target date retirement fund where as they get closer to retiring, it will automatically peel off those alternative investments. You don't have to worry about the liquidity factor as you get older. One, two, I think there has to be some sort of training. So just like you and I,
Hmm.
if we go out and recommend obscure financial product to a client, we have to do extra training. And
Yes.
there are, training videos you can do and like so many ways that you could make this education accessible to 401k participants. So that's another thing that I think absolutely should be in place is you have to take a training video class or whatever. It doesn't have to be long and then pass a test to make sure that you fully understand what you're about to put your money in, and only then should you be allowed to put any of your 401k money in something like this. So I think
Yeah.
with some protocols in place, some protections in place, it could make sense. But I think you and I are very much on the same page generally about it.
Yeah. And I think also to your point about there's got to be some consideration around how you restructure management fees in these kind of products. When we were preparing for this recording, I just looked it up and I think the average expense ratio of the mutual fund in a 401k plan is about 26 basis points or 0.26%. That's incredibly, incredibly cheap
Yeah.
for an actively managed sort of investment fund. And when you think about what these products traditionally cost, they could be 4, 5, 6 times that amount, right? In some cases. So there would have to be some consideration of how you change the pricing structure if they're actually going to be added to 401k plans. There's no way you could, in my mind, as a fiduciary, make that make sense in a
Yeah.
401k plan. I don't get how you rationalize that for a plan administrator.
Yeah. Exactly. Agree. So it'll be interesting. It'll be interesting to
Yeah.
see how this shakes out, what plan sponsors decide to do, how they deal with the fiduciary aspect and the possible, lawsuits that could come about, and how to give their participants access while also making sure that they're being safe about it and not blowing people's retirement plans up, right? Because that's what you don't want is for people to put all their money into crypto or into a private
Right.
asset, something goes wrong, and then, they're 65, ready to retire and have no money in their 401k.
Yeah.
Can't happen.
th-
So,
Yeah, it would be terrible. And again, it's still going to be some adoption considerations too, because even when
yeah,
designing a 401k plan, the administrator gets to select what the investment universe looks like for its participants. So it'll be interesting to see how quickly the administrators will be willing to adopt these kind of products in their plan as well.
yeah, exactly. I think it's going to be a while, right? Because
Yeah,
it's the
I do
executive
too.
order doesn't say like you must offer these products tomorrow. It's like let's give them access to the products, but there's so many things to figure out first. So
Yeah,
going to
for
be a
sure.
while. All right. Well, hopefully that was helpful as you consider this decision for yourself when and if you get access to it. So, Teresa, what do you have as a closing thought today?
Okie doke. So I am obsessed with a television show called The Gilded Age. Comes on HBO Max. I've been watching it since season one, but this most recent season that just ended was fantastic. And then for those of you who don't watch, and this story is going to take a turn, so just bear with me. But for those of you who don't watch it, it's basically a period piece about the robber barons of, the 1800s in New York, and how families like the Vanderbilts and the Astors and, Carnegie's, all the names we know on all of the libraries, how they came into power and wealth and money. So it's loosely based on those kinds of families, but it's a fantastic show. Anyway, the season ended. I'm still obsessed. So I go down a rabbit's hole. I just started looking into different content, and I came across a podcast with Christine Baranski, who is an actress in her 70s now. She's been in Hollywood, I think, for the last 40 years. But you may know her from shows like The Good Wife. She's been in a lot of different, but she's an excellent actress. One of my favorite characters from The Gilded Age. She plays Agnes Van Ryn in the show. But she's just kind of evil, but in a delicious way, and just mean and rude. And I don't know. I just love her. But I came across a podcast she did with Beth Smith, who is like a fashion influencer who's been around the industry for years. And they were talking about, her being sort of getting this notoriety for the show at such an advanced age, right? She's in her 70s and now
Yeah.
she's being picked up and talked about, even though she's been in Hollywood in forever. And she was saying how she really didn't even take off in her career until her 40s. And with each decade, she's kind of seen her career grow. And then she made a statement on the podcast that I'm learning that it gets greater later. And
Ooh.
yeah, and it hit me in such a way. Like, here's a woman in her 70s experiencing like this great career boost, right? Being on a wildly popular show that everybody's talking about. People absolutely love her character. And she basically was saying, like, this didn't just happen overnight, right? It's been years of me working, but the more I work and the longer I stick with it, the better I'm getting and the better life is getting. And I thought that was just such a great thought. Like, it gets greater later because, as not so young girls ourselves who are moving into this next phase of our life, I think it's a good reminder, right? That it's never too late to try the thing, to do the thing. Who knows? You may not find success until you're 50 or 60 or maybe even 70, but it's still potential to get greater later. So that's my closing thought for today.
Absolutely.
It gets greater later.
I love that. Greater later. Yeah. Well, I mean, Warren Buffett built like most of his wealth. I can't remember I'm pretty sure it was after 60. So,
Yeah,
so many examples of people having wild success
yeah,
later in their life. So we're like super young compared to that.
yeah, for sure. So many years to go.
Oh, we're babies. Babies. Awesome. Love that. So my closing thought is, y'all know probably by now, and Teresa certainly knows, I can be a little woo-woo. And my woo-woo thing to share with you today is if you are ever struggling to make a decision, Teresa and I are kind of working on some things business-wise that we have to make decisions about. And they're, not always straightforward. It's not always like black and white. Sometimes it is. Sometimes we're like, yeah, that's an easy answer. But
Yeah.
more times than not, there's, some gray. And so one of the things that I love to do when I need to make a decision and I'm kind of, struggling with here are the reasons why we should do it. Here are the reasons why we shouldn't do it. And I kind of like still don't come to a decision is right when I'm about to go to sleep. I bring up the decision and kind of just like think about it. And I ask my subconscious mind to work on it while I'm sleeping. And then I go to sleep. And oftentimes, not always, but oftentimes I'll wake up in the morning and I will have a sense that like my subconscious mind was like busy at work as I was sleeping overnight because your subconscious mind, continues to work all
Right.
the time. And, oftentimes I will wake up in the morning with some clarity around the path forward. And so, again, I know it sounds crazy and woo woo, but if you are having to make a decision and you're kind of going back in, around in circles in your awake, conscious mind, give this a try and let us know. Let us know if you try it.
I like that. It's a little surprising just because I also know how fact-based you can be around
Yep.
decision making. Like you like to review the bullet points.
Yep.
So it's actually interesting to hear you say that, but I do love the idea of letting sort of your deeper consciousness wrestle with it and help work it out for yourself. That's very intuitive of you, Anne, which is
I
very unlike you.
know. See how much I can stretch? Let your rubber bands.
Well, I really hope that you woke up with some clarity around the current decision that you and I have to make. That would be fantastic.
I did. I did.
Good.
More to
Can't wait to
follow.
hear it.
More to follow when we're not recording.
And we're right when we're offline.
Yes,
That's wonderful. I
exactly.
like that.
Exactly. Yeah. Yeah. So give it a try. If you do try this, let us know. Tag us on Instagram. We are at Curo Private Wealth. So find us on
Yeah.
Instagram, follow us, and let us know. Tag us in, and we love to hear from you all. So make sure you let us know. All right, y'all. That's a wrap for another week. We will see you here again next week, and until then,
Live richly.
thanks again for tuning in. If you enjoyed today's episode, please be sure to subscribe and share it with someone who might benefit from it. Friendly reminder that this is for informational purposes only. For additional information, please visit us at www.curoprivatewealth.com. Until next time, live richly.